Is this the worst property market downturn in 30 years? Because the headlines have gone into meltdown mode, and we're seeing headlines like Australia's housing downturn echoes worst in 30 years, just from Domain recently. I think we had news.com.au saying that Sydney and Melbourne house prices are plunging in a severe collapse, quote unquote. And there's a lot of noise and emotion and fear in all of that. And I don't want to dismiss the weakness in the market. The market has changed, it's shifted, but we need to separate what's a useful signal to us as property investors and property renovators and property developers from these panicky headlines. There's a big distinction between being calm and rational versus being complacent, reading the market properly in spite of the headlines. And hopefully we'll get into some of that today.
Let me go through some of the latest data available via Cotality. Melbourne's prices have fallen by about 4% in 6 months. Sydney's prices have fallen by around 2.5% in 3 months. Brisbane and Adelaide have both just peaked in the last couple of weeks. And Perth is still in growth, growing at around about 2% in the last 3 months. So the changes quarterly, the market's diverse. It's not one broad market. The aggregated perspective on the market right now says that we've gone down nationally minus 1.7% in the last quarter, approximately. All right. So what does that actually mean? I mean, if you're looking at national terms, it hides the volatility and the variety of price movements in different markets. Even if you're looking at cities, we've just identified there are different rates of growth occurring in cities, some decline, some growth. But then you get down to suburb level or LGA and suburb level, and you've got a wide dichotomy of what's occurring in those areas, about some being significant growth, some being marginal decline, some being reasonable decline. There's a lot going on. And we always, Simon, go back to the idea that you're not actually buying a city or you're not actually buying a country. What you're buying is an individual property in an individual market within one suburb. So there's a requirement to understand what's happening locally in your environment. No question that the broader market media does influence sentiment, and we are seeing that, of course. But I don't think it's necessarily a panic scenario at this point. What we've got is a scenario where media is just going, I need to make money. How do I make money? Advertising. How do I get attention to the people who are advertising? I know, I'll go radical, bold, almost stupid headline statements to attract the attention of readers so that my marketing dollars are substantiated. We need to read beyond the headlines. Simon.
It's true, and it's not just mainstream media either. I mean, more and more people these days are getting information from social media, and that's even worse when it comes to the extent to which it needs to be extreme and alarmist in order to get the views, get the clicks, get the followings. I shout out to Mark, who's on the session today, forwarded me a screen grab of a social media post from a few days back. And admittedly, this was in the context of the US property market, but it was screaming out that there was going to be a 50% decline in property values because properties were just so high relative to people's incomes. And I read a headline like that. If that was in an Australian context, I'd be like, woohoo, 50% discount on property. How awesome would that be? Let's go on a buying spree. Bargains are plenty.
Of course, you'd have to be prepared for that, but yeah, sure.
But how real is it? And this is the thing. It's alarmist. It's there to get your attention, get you to click through and out of curiosity or fear and find out what it's about. And the mainstream media really is no different to that. And we need to be mindful of that. When they scream crash, we need to go, well, hang on a second. What's really going on here?
I did a little bit of digging through histories and what price crashes and the size of price crashes, the massive great event things that have occurred. since 1900. And broadly speaking, you had the Great Depression, which had a broadly 20% type drop. Period of time for recovery was less than 10 years, but it recovered, obviously. 1950 was the removal of the price control post-war. That had around also about a 20% drop, but they're the two greatest drops that we've seen.
And those
Um,
drops would have been spread over a period of time as well. They didn't like happen in a month or anything like that, did
oh
they?
no, no, no! It took probably about 2 to 3 years for some of those things to really hit the bottom, and then there was a quick recovery from that, not as high as the original at a high point, and then a steadying along in the broader market as it started to recover more broadly. 1970s had stagflation. That was about a 15% drop. The 1990s recession we had to have, that was only around about a 10% drop. And interestingly enough, the more recent APRA changes from 2017 were lending restrictions accompanying a let's get rid of capital gains tax election promise in 2018 had a more sustained decline, and that total decline was around about 15%. You go back to 2022's interest rate growth, and that was even that was what 7%. So where are we at now? If you say the worst in 30 years, it's a little bit dramatic. I'm seeing that perhaps not. There is some sentiment shift, of course, that is occurring. We are seeing the tax changes having an impact, and that's a fundamental impact in the broader market. Back in 2000, when that was instigated, that did change the nature of perspective around housing. This has changed it again, and I guess shallow the depth of people of investing wanted to get in there property and for buy and hold wealth creation, but it's not going to stop that. A reduction in or a conversion from a 50% to an inflation based model is not that significant a change, and within a few years you're going to get rent prices changing, etc. So there's a panic scenario occurring right now. What do I do? What do I do? I want to keep investing. I don't know where to go, or I don't know what to do, from buy and hold investors. So they're kind of pulling out. You've got a tax change, particularly in Melbourne, that have caused an exodus of investors from Melbourne to other states, which has supported the growth in other states, being Brisbane, Adelaide, and Perth. You've got the mining boom occurring in Perth, which is still underway because of the rare earths and the requirement for that, given all the AI and data center creation that's occurring. So there's a lot going on in the broader market, and we've still got the ongoing shortage of houses. There's a accord for 20,000 a month. We're still 5,000 a month short, and that's not changing. So we've got really conflicting information and dramatic statements. No wonder there's a little bit of confusion out there. But are we expecting really a 30% fall? And the answer is no.
Yeah, I mean, one other element that's been hitting the press just in the last few days around this, which really affects that established housing market, perhaps more than the new housing market as well, is that we've still nationally got vacancy rates under 1%. And there's plenty of reporting at the moment. Again, got to be careful about generalizing, but about rents being at record highs and still going up. And of course, with investors perhaps less inclined in the moment right now to go out and buy more established properties and turn them into rental homes, then that supply is not going to improve. And so the pressure is going to remain there on rents. So there's all of these things going on in the market that don't necessarily get reflected holistically in a dramatic headline. But Brendan, I think that people do feel what's going on, and we're emotional human beings. As much as we like to pretend as investors that there's no emotion in our decisions, we got base emotions like fear and greed as part of being human that influence our decision making. This downturn feels different to a lot of people, I think, because it's a combination of factors. It's not just one thing. You've got the higher borrowing costs because rates have gone up fairly quickly this year. You've got uncertainty about whether rates might go up again this year as well. You've got generally weak confidence from all the geopolitical noise with the Middle East conflict blowing up again in the last few days. You've got ongoing cost of living pressures because of the price of petrol and so on. And we've got those budget tax changes. And we obviously have done a number of recent fireside chats and results mentoring program webinars unpacking some of that. So that all of that leads to a whole lot of hesitation, not just amongst investors, though. In terms of buyers generally, you're seeing the buyers hesitating, and that media amplification, if you like, of these panicky headlines is just kind of feeding into that sense of uncertainty. So that's what people are feeling right now. And in the short term, it really is that sentiment, I think, that drives behavior in the property market. It drives transaction volumes. It drives whether people are quick to buy or slow to buy. And we're really seeing that reflected at the moment. Brendan, is it a market crash?
There's no one dramatic event that is on the horizon that says crash pending. Right.
Yeah, there's nothing there that is going to create extreme credit stress. I mean, even if rates go up another quarter of a percentage point this year, as roughly half economists anticipate, is that going to be so much that it puts so many people under financial stress that they go to the wall and there's mass foreclosures? No, of course it isn't. So you're not going to see that forced selling that would drive broad falls. There's no indication at this stage you're going to see things like mass unemployment that would drive those sorts of falls. So I think it's whilst it's great clickbait to talk about prices crashing, property prices coming down 0.4% in a month or 1.4% over a quarter hardly qualifies as the definition of a crash, in my opinion. So I think we're a long way away from that.
There's also the structure of housing in this country is one of sustainability. The recourse lending required means that if you're in a scenario, let's say, where you've got negative equity and you sell, you still carry the borrowing or the remaining debt with you. People will go without food rather than go without their house. So you just downgrade from your Wagyu beef into baked beans on toast and you survive for what you need to. You pull the belt in tight. People will adjust to an environment, create a new world order for themselves, a new level of equilibrium for themselves and tolerances. They'll acclimatize to those tolerances and go, okay, well, I'll loosen the belt later when I can. If we need to dig deeper, sure, there's more pain, but we have now acclimatized to this. We actually are, I see that there is probably latitude here, and here that I need to go back on. And there is a period of adjustment which is uncomfortable. And what we're going through right now is the period of adjustment. All the drama, all the news headlines is the period of adjustment. Once we've acclimatized to that and there is no new volatility, once we get to a calmer environment, and admittedly in my mind we probably need to lose the orange man in order for that to happen, but if we move away from into a more stable environment, people acclimatize to a new tolerance, and with that then comes a growing confidence. It's just the nature of humans to be relatively optimistic about the future rather than consistently pessimistic, but to grumble about a change that's been forced upon them. And right now we're going through a change that's been forced upon them with still some uncertainty about that remaining. And the uncertainty and the change is causing the level of anxiety, and it is brilliant for clickbait headlines.
That's
For
right.
feeding into that. And that's kind of where we're at as a society, as a human state within this population.
Yeah, I agree. I think uncertainty is what's actively shaping buyer behavior right now. So we're not seeing a crash in the property market. You could argue that it's a so-called correction or a downturn, and those terms are used pretty loosely out in the media. But if you've got a period of months where you're actually seeing prices in many parts of the market falling off, then you could categorize that as a downturn. So maybe that's a little bit more accurate in terms of some terminology. But Brendan, for those of us showing our grey hairs here who've been investing for more than just the last 3 or 4 years, property prices don't always go up. We have many periods, and you listed a few right across history, but even in more recent times, we've had plenty of periods where property prices generally bring them up to an aggregate level, but also specifically in certain pockets, suburbs, cities, regions, have gone down for a period of time, gone sideways for a period of time, rather than going up. And what we've had really in the last 3 or 4 years is a very unusual period in some parts of the country of some very steep growth, which is never sustainable. That's not the norm for the property market, but people, I think, have very short memories and they get used to that. And then the moment that stops, it's like, the sky's falling. What do I do? Panic, uncertainty, they freeze up. And that's where we as smarter investors need to more intelligently assess what's going on. When the media talks about the market, as smarter property investors, we should be asking which market. And the point you made earlier, Brendan, I think is very, very relevant. We should be looking at what is actually happening in the suburbs and for the type of property that we are actually interested in working with, or that we already hold in our portfolios. That's the key. So in terms of what people should be paying attention to, what are some of the key metrics, the key data points that you think an investor should be looking at for the suburbs that they're interested in?
So if you've got property and you're going, I don't know where it's going or what's up to, and you just want to check in on it, perfect. How do you do that? You're basically looking to monitor listings. What are listings doing? You monitor sales. What are sales doing? If listings volumes climb relative to sales, then you know you're in a price easing market. So monitor that. And that would be the greatest indicator. And you support it with the other data, vendor discounting, days on market, they support it.
Yeah. And I think if you really want to understand what's going on in your local market, in the suburbs that you've got property or you're looking to buy, it's critical not to be a desk jockey. You've got to get out into the field, get on the ground, attend the open, see what the actual behavior is on the ground, go to the auctions, see what's happening, to really understand the immediate trend, and potentially then, if you're looking to buy, the immediate opportunity. Like, how strong can your negotiating ability be?
Right now, the desk jockey data that's available to you is suffering a lag time. There is a problem with looking at data that says 12 months ago it was this, today it's this, therefore look at the growth that's occurred. What boom, what despair are we talking about? The data says it's in growth, but the lead time, well, you're talking a year's difference. And the data collection process, publishing process, aggregation and cleaning process takes time. It's typically 3 months old. So we need to be really mindful of looking at desktop data right now as an indicator of what's actually going on. And Simon's right. Get on the ground. Go to the auctions. Talk to the real estate agents. Now, with the greatest respect to real estate agents, one real estate agent's perspective does not make a truth. However, if you get multiple real estate agents and they're all saying the same thing, then there's elements of truth within that, and that's where you need to be. Talk to multiple real estate agents to get the perspective on the ground, what's happening there relative to the suburbs you're interested in buying into or selling into. Now, Simon, you and I went through a webinar yesterday, in fact, talking to results members around what to do as a buyer, what to do as a seller. If you're a results member listening to this, but you haven't heard that webinar yet, can I encourage you, get into the results membership part of the real estate success community, get into that section, and then listen to that webinar about what to do as a buyer, what to do as a seller.
Some of the key things here, I mean, obviously avoid the extremes. Don't panic sell just because of headlines, but equally don't blindly buy something just because prices are down. You need to understand those trends and those metrics that we've been talking about in the suburbs to make sure that you don't buy on a downtrend and see your values fall anyway. So there are good opportunities out there, though. The problem with this sort of uncertainty is people wait for more certainty. And by waiting for more certainty, they miss the opportunities. There's never going to be a perfect time to invest. You'll always find reasons not to invest. You'll always find some level of uncertainty. The key is to look past that, look at the metrics, look at what's actually happening on the ground, look at what you're trying to achieve financially, and then act to seize the opportunities. But just don't go out there assuming that anything that a vendor is discounting is some sort of opportunity, because it may not be. Your due diligence is still important. The better response is to understand what's changed in my borrowing capacity, because your borrowing capacity may have shifted recently. Put some additional buffers into your numbers, into your feasibilities. Be more conservative around your feasibility assumptions, your margins, your selling prices in particular. Negotiate hard, though. You have a key opportunity to negotiate harder when sellers are motivated, and that's a key part of the opportunity in the current conditions as well. But when you're picking the properties you are going to negotiate on, a couple of key things to bear in mind. Scarcity. What is inherently scarce about this property or what I'm going to turn this property into, and make sure it is in fact scarce and that there is local demand for that property to help lift its value, help maximize its rents, help create the profit if you're using an active strategy on it. And on that point, looking for manufactured growth rather than relying on broad market-driven growth is a key strategy for the current conditions, because panic isn't a strategy, but nor is treating everything like nothing has changed. So you need to look at the strategies you're applying, the tactics you're applying, and adjust those for the current conditions.
Now, if you're a new member to the Real Estate Success community, welcome. If this is your first time in a Property Pulse, really appreciate you joining us for this, and I hope today's conversation was valuable for you. As a new member, if you haven't updated information into your profile, can I encourage you to do that? It makes a difference in your ability to reach out and build networks, to get to know people, get to be around like-minded thinkers. Guys, I want to thank you ever so much for joining us today. We wish you the very, very best in the week ahead, and we will see you next Thursday, 10:30. Be great. See you guys.
Thanks, everyone.